Hey everybody, welcome back to Layman Loans. In this video, we're going to see how you can close multiple loans. There are different theories in which people say, like the high-tech terminologies, avalanche method and snowball method. There are so many methods available, but as you know, this is Layman Loans. This channel is meant for laymen like you and me. So we are not really going to focus on the jargons, but instead we're going to tell you few simple proven methods which you can use to close your loans. So when you have a lot of loans, so assume you are working in an IT firm, you earn about 1 lakh in income and you currently have a couple of loans. You have a credit card loan, you have a home loan, a personal loan, a loan against property, and say you also have some loan against security. So typically you have some 5 to 6 different loans, and on top of all these you have some gold loan also. Each of these loans have different rate of interest. All right. So if you consider a home loan, the rate of interest will be about 6 to 7% or even maximum 8%. A loan against property will have about 10.5%. A credit card EMI or credit card loan will be typically about 40 to 44%. So based on the value of the loan and the rate of interest, you have to prioritize the loan and start closing each one. So how can you do that? First and foremost, do not really bother about the very high value loans with very low interest rate, because for you to close such a high value loan, you need to have a lot of capital, and maybe when you are just deciding to start closing all the loans, you might not be having a lot of capital unless until you have sold some big property of yours and you are really cash rich. This video is not for those people who have a lot of funds and they are just going to close off all the loans. That's not the way in reality things work. You are actually in the same position wherein you are earning a stable income, could be from your business or from your salary, but you have a lot of loans and you want to close all the loans eventually. So how do you want to approach that? Firstly, look for the small loans which you can easily close and which have the highest rate of interest. So you should not make all your income be eaten away by high interest rate loans. Always remember that small loans are a lot more picky and a lot more painful to close than big loans, because small loans value is very small, but the tenure is also very small and the rate of interest is very high. If you consider a personal loan for 5 lakhs, the entire tenure will be like 2 to 3 years or maximum 5 years. And the rate of interest will also be sky high. It will be like 14 to 15% or even up to 19%. In this case, your interest EMI amount along with the interest and principal will be pretty high. For 5 lakhs loan, you will get somewhere around 40 to 45,000 rupees as the total EMI amount which you need to pay. If you consider a home loan of 50 lakhs spread across a period of 20 years, even for that loan, you will get only 35 to 40,000 rupees as your EMI. And when you are paying your home loan for a pretty long time, 25 to 30 years, that amount is actually pretty small as compared to the rate of interest. And when you compare that to that of a personal loan, it's significantly bigger. So you always try to close the loans which are of higher interest and low value. That is the first step. And secondly, try to generate enough funds wherein you can make part payment for your high value loans. In most of the banks and NBFCs, when you make a part payment, they allow you to actually adjust a part payment for the EMI amount or for the tenure. So assume you have taken a home loan for about 20 years time and you have taken about say 50 lakhs, and right now after 3 to 4 years you have about 10 lakhs in hand. Try to make that as a part payment towards your home loan. What happens is you can either adjust the entire tenure. Instead of 20 years, you can make it say 12 or 13 years by after making this part payment, or you will be able to reduce the overall EMI amount. So assume your EMI amount was say 80,000 rupees. After making this part payment, it will become say 60,000 or 50,000. So based on the amount what you contribute, subsequently your payment values will keep reducing and your burden will keep on reducing. There are several techniques what you can deploy in order to keep saving money on a regular note and using them in order to close off all these loans. We have a separate channel called Layman Investment, wherein we teach you how to save liquid cash and try to amortize all these loans as well. So in this particular channel, we primarily focus on getting loans and making yourself eligible to take loans, and how do you utilize those loan funds. That's what we teach in this particular channel. But how do you really make savings? How do you make your money work for you? How can your money really grow is all taken as a separate channel called Layman Investment. I'll leave the description of the Layman Investment as well. In the description, I'll leave the link for Layman Investment channel as well. Please do check out those videos as well. Alright, so this is the first approach wherein you close the smaller loans with higher rate of interest, and you then close the bigger loans by making part payments. This is the first approach. Second approach, what you can do is called the balance transfer method, wherein you try to get one big loan which is going to encompass all your other loans, settle off all those loans and make one single payment. So let us take this with an example because it's slightly complex, right? So assume you have a personal loan, a credit card loan and a car loan. So all these EMIs together account about 1 lakh. But right now you need some more additional 10 or 15 lakhs money for meeting your daughter's marriage or something like that. Then what can you do? Can you take another personal loan or a business loan? First of all, you cannot take a business loan. If you're going to go and take another personal loan, it's going to invite another 18 or 19% rate of interest, and your EMI is going to be so high. Possibly you might not be eligible to take another personal loan. So instead, you can take a loan against property. If in case you're living in your own house or you have some property, you can take a loan against property and settle off your existing loans and get an EMI value which will support your new loan and at a lower interest rate, and all your existing loans also will get cleared. And this can be done directly by the bank which is lending you as well. And there are several NBFCs and banks which are more than willing to settle your existing loans and give you sufficient funds through which you will be able to pay that amount as well. So let us assume you have a car loan wherein you have a EMI of 20,000 rupees. You have a personal loan wherein you pay 30,000 rupees, and you have a credit card EMI of another 10,000 rupees. So you are paying about 60,000 rupees as a total amount for all these three loans. These three loans are considered to be short-term loans, mostly which are under 3 years or maximum 5 years. But if you're taking a semi-long-term loan or a long-term loan for 15 to 20 years or even 30 years, then your EMI amount will become negligibly small and you will be able to take a higher value loan as well. So if you're taking a loan against property for 50 lakhs, possibly all your existing loans will get cleared by about say 10 or 15 lakhs you have existing loans. All those 15 lakhs loan will be automatically cleared, and for that 50 lakhs you will actually be paying 50,000 rupees in EMI. Maybe with all these three loans together you would have paid 60,000 EMI, but now you would have cleared all these three loans as well, and you will get extra liquid cash of 30-35 lakhs for which you will be paying only 50,000 EMI, which is a lot more cooler, right? So you have higher liquidity and a lower EMI. This is something which you have to always opt for you to really make it very comfortable for you to pay the EMI. Third thing, whenever you are looking for a higher value loan, say something in crores or something more than 50 lakhs, go for the highest tenure possible, wherein you take a loan for 15 to 20 years or 30 years. Only then your EMI amount will be small. Don't take a loan which is for 5 years or 10 years, but the amount is so high, because the overall EMI value will become very high. If there's a possibility from your bank wherein you can take a interest only loan, wherein you pay only interest, like in the case of gold loans you pay only interest, then that is even more cooler, right? You will have a lot of cash flow with you, and you will not have to spend a lot of money in repaying the principal on a monthly basis. You can save that money, reinvest in your business and generate enough cash flow in order to actually settle those loans in a periodic manner. So whenever you're going to take a higher value loan, try to stretch the loan to the maximum tenure possible. Only then you will be able to reduce the EMI burden, and whenever you have enough funds, try to make part payments so that you can reduce the tenure or reduce the EMI of your loan. I hope these tips are useful to you all. If you need any guidance in getting a new loan or how to reduce and close your loans, we are always there to help you. Feel free to reach out to us by filling up the form mentioned in the description and comments below. I hope you have enjoyed this video. Looking forward to connect with you all in the next video.